Traders, welcome back to another weekly workshop. So in this workshop, let's talk a bit about managing drawdowns. The main reason why most of you may find that lots of my workshops are on the mindset side, are on drawdown, trade management, etc. The main reason is because the reason why you are in this community, Neometrics community, most likely because you can't find consistency, right? You can't find consistency, and trust me, that problem doesn't come from your technical skill, because all of you have been here for over 1 month, some of you 2 months. All of you know yourself clearly that you can trade, right? You can trade. You know break and retest, you know what is support, you know what is resistance, you have a certain strategy, but the main thing is every time when drawdown comes, it just gets deeper, or you may find yourself get into a situation where you earn a lot of profit. Maybe you make 15R this week, but next week you give all of them back. So this relates to how do you manage your drawdown. So this is a very important topic. I cannot highlight this enough. And so let's talk about the first method. So the first method, you don't even have to look at the chart. Is actually to have a max daily drawdown. So it seems very simple, but trust me, most of us, when let's say you take a loss and then you goes on and take second loss, third loss, fifth, fourth, continue, it goes on. If you don't have a daily drawdown limit, it basically means you don't care about your risk. Every good trader have a maximum daily, whether it's dollar amount, whether it's percentage amount, that they're willing to risk every single day. You cannot go beyond that. I don't care if you, after you take 3 losses, that's your max daily drawdown. You saw a fourth trade that seems like is very profitable, it seems like the success rate is quite high, you cannot take it, because that is what I refer to discipline. You need to have the discipline to stick to your plan. What is your plan? Your drawdown limit. If you don't even stick to it, trust me, maybe this time you get caught lucky. You take 3 losses. That's within that's the max drawdown you can have in your trading plan. Then you goes on to take the 4th trade, and so lucky that the 4th trade is a winner. Trust me, the next time after you have three losing trades in a row, you will still take the 4th trade. You will say, why not? Let me just take this. What if this is the winner of the day? What if this trade allows me to recover all of the early losses? So don't have this kind of mindset, because a wrong habit that you consistently do will eventually become unrecoverable, because you can't fix it anymore. It has become a habit. So before this kind of bad negative behavior turns into a habit, you need to correct things first. Right, so that's the first point. Have a maximum daily drawdown. I don't care whether it's daily drawdown, I don't care it's weekly drawdown, I don't care it's monthly drawdown. Have something that guides your maximum risk, whether it's per day, per week, per month. What I suggest is go for daily drawdowns, because a lot of times, if let's say you have a monthly drawdown limit, which means you don't really care how much risk are you putting in per day, right? What if your monthly drawdown limit is 10 losing trades, and you basically blow up your 10 losing trades in the first 2 days of your trading month? Then what should you do? So for the rest of the 20 plus days, are you just going to sit in front of the chart and do nothing? It doesn't really make any sense. So if let's say your trading capital is 50,000, just an example, or maybe 10,000. So you will tell yourself the maximum drawdown I can have per day is probably $200, 2% risk per day. Reasonable. Or maybe if you want to have a little bit buffer, $300 risk per day. That's 3% of 10,000. Reasonable. If it goes beyond 3%, are you going to allow yourself to have a 10% drawdown day? That is insane. If you have a drawdown for 10%, for consecutively 4 days, what is it going to be like? 40% drawdown, 40% drawdown in 4 days. How are you going to recover that deep hole that you have just contributed to your current situation? So that's why I say you need to, a good trader, a professional good trader is always the best risk manager. Not to other people, but to yourself. Be honest to yourself. If let's say you have maxed out your daily loss limit, don't touch the chart. Step away. Come back tomorrow and do your self-review in the morning. Trust me, you'll get a lot more clarity in the market. A lot more clarity. Right? So that basically sums up our first point, is to have a max daily drawdown. So the second method is what I call reducing your size or reducing your risk per trade. So let's move into the chart, and I'll just simply do it, show it all to you. How do I usually manage a bad drawdown, or whenever I feel like I have a big winning streaks? I always tell myself to calm down, because the losing streaks is about to come. All right, market works in cycle. The same thing goes to your trading account. It works in a cycle. There will be a cycle where you are basically just blooming in the market. You win a lot of trades. Whatever you do, it just seems like you are making money, whether you follow your plan or not. Even on trades that you did not follow any of your plan, you still make money. That's what we call luck factor. It does play a role in the market. So if you look at the chart here, let's assume, so how do I manage a winning streak? So let's talk about winning streaks first. All right, so winning streaks. So let's assume right now you have 5 winning trades in a row. You take a trade, it's a win. Let's say it's a win, it's a win, it's a win, it's a win, it's a win. 5 winning trades in a row. Usually after 5 to 6 winning trades, so you can do this on your own. You can adjust to whatever your own liking, whatever your own trading style. 5 or between 5 to 7, I'll say that's reasonable. Whenever you have 5 winning trades in a row, I want all of you to start dropping your size to maybe 60, maybe 50 to 60, 70%. Sorry. So what do I mean by that? If let's say your usual trading size is 20 lots, 20 lots, 20 lots, 20 lots, 20 lots, and then on your 6th trade, which you have no clue on whether if it's a winning trade or losing trade, I want all of you to start dropping the size to 10 lots. So that's in lots. If let's say it's in risk per trade, so it will look something like this. 1, 2, 3, 4, 5 winning trades. Here's 1% risk, 1% risk, 1% risk, 1% risk, and 1% risk. So on your 6th trade, I don't care whether it's a winning or losing trade. I want all of you to drop down the risk to maybe 0 to 5 to 0.5 to 0.7%. Why do you do that? It's because every time when you experience a winning streaks, most of you know that the moment you get into one losing trade, you have the tendency to experience more losing trade. It was not because you don't know how to trade. It's purely because it's all about probability. It's all about coin toss. It's all about cycle. If you have a good time, you will experience bad time or flat time. Right? So when you drop down the risk, I want all of you to observe whether if the losing trades are coming or not. So on the 6th trade, if let's say when you drop down your risk and you notice that immediately on this one you really get into a loss, so you remain this risk for the remaining of your losses. If let's say on the 6th trade you take a loss, on the 7th trade you again take a loss, so this remains 0.5 to 0.7% risk. Maybe on the 8th one, continue, then you remain the risk again. But on the ninth one, if it's a winner, then after this trade, bear in mind on the ninth trade, this trade you are still using 0.5 to 0.7% risk, right? Because you have not experienced any winner yet. But right after you get this winning trade, I want you to go back to your initial risk, which is 1% or whatever percentage amount that you're risking. Then you are allowed to now go back to your initial risk. So you might think, if I do this, wouldn't it affect my overall expectancy or or success or my overall trading success? It won't, because based on my data and based on the way I've tested it, the outcome, of course, of sticking to 1% risk, which is what we call a constant risk per trade, in the long term is going to make you a bit more money. But vice versa, it also creates a larger equity swing. So if let's say you don't care about this method that I just taught you, every trade, whatever you take, you just remain 1% risk, right? This is on a winning streak situation. So you continue using 1% risk throughout all your winning and losing trade. You will see your equity curve look something like this. If you have a plan, eventually it will still go up, but the thing is your swing is a lot larger as compared to the method I just taught you. So this one is more to an advanced method, but again, the main purpose of us doing this is because I want all of you to acknowledge drawdown, to acknowledge that we will have the tendency to encounter drawdown. That's why we prepare ourselves beforehand. I don't mind if let's say the sixth trade is still a winner, it's fine, it's fine. But I understand that if let's say the losses come, I'm reducing my loss. I'm reducing my loss. If let's say it really happens to have a losing streaks, I am taking a step back by reducing my risk per trade to half. That really slows down your drawdown. So now your equity curve maybe is not as high. Maybe over 1,000 trade, this make 100% return. Just an example. But on the second method that I just taught you, with some sort of a risk management trick, you will see your equity curve a lot shallower. There will be time where you have flat equity curve, but then eventually you still pump up. Maybe over 1,000 trade you make 80% return. But which one would you rather have? For me, I go for the second one, because I'm not in a phase or in a stage where I want to risk way too much. I do not want to have a huge swing on my equity curve, because I want stability and I want consistency, right? So you can try on this method. So second point. So on the first point, I say that you should have a max daily drawdown, weekly drawdown or monthly drawdown. Second point, I say that you need to manage your risk, right? So just now I talked about winning streaks. How about losing streaks? So let's talk about losing streaks. So if let's say you are really encountering a losing streak, let's say you have one loss, second loss, third loss, fourth loss, fifth loss. So assuming you follow the way I say, or maybe just assume you did not follow whatever I just said earlier. After you have 5 loss, I want you to take 1 to 3 days break. So it might not sound so reasonable. You might think that, what if I don't trade and the winning streaks comes back? You might think that way. But most of the time, trust me, whenever I take a step back, it helps me in one big thing, which is clarity. Of course, I'm not telling you to just take 1 to 3 days break without really looking at the chart. I want all of you to take that 1 to 3 days to just observe the pattern of your winners and losers. Trust me, every single time when I experience any A big drawdown, don't say small drawdown like 1 or 2 losses. Those are just normal. Those are just an investment to make more money. Yeah, if it sounds right. But every time when you experience a deep drawdown, there must be certain pattern that makes you go dig yourself into this huge drawdown. And then if you continue trading the market and you don't try to find a solution to it, or if you don't try to tackle the problem, you will eventually digging yourself into a deeper hole, deeper hole, deeper hole, then eventually it's not recoverable. For me, any drawdown that goes beyond 10% is sort of crazy. It's sort of crazy. Yeah, because if you have a proper risk management, you shouldn't really go beyond 10% drawdown. Especially if you follow the earlier drawdown model that I just taught you. It's nearly impossible to experience 10% drawdown, because you are risking, let's say, 0.5% per trade after you experience a loss, after a good winning streaks. Then you start dropping down your risk. So a lot of traders, the reason why they blow up their account is not because they can't trade. After I've said this so many times, it's purely because they do not know when to switch on the aggressiveness and when to switch off the aggressiveness. There are times when you are absolutely outstanding in the market, you need to go further, you need to step the pedal, you need to risk more, you need to scale into your winning trades, because that's how you create an equity curve like this, right? This period of rally, this period of trend on your equity curve are due to the fact that you have a proper plan and you capitalize on good opportunity. There are bad opportunity and there are good opportunities. When there's a good opportunity, you need to step the pedal harder. You need to go all in. You need to pay full attention to what you are good at. That's how you make more money in the long term, right? In the long term, right? So it sums up the second technique, which is managing your, which is having the first one is having a drawdown limit. The second one is basically managing your risk per trade, right? So it sums up that, and again, after, I'll say anything beyond 5 to 6 losses, you need to start reviewing your trade. You have to, because there definitely are certain patterns that they are contributing to your losses. So the third point, which is managing your position, what we call trade management. So I've said this, I think last week or a few days ago, I talked about how do I scale out of a position. So scaling out may seems like same thing, will affecting your long-term expectancy. Yes, it does reduce your long-term profitability slightly. It's not a lot, actually it's just slightly, but it helps stable down and make your equity curve more consistent as well. So for someone who have a set and forget approach, what is set and forget is basically let's say you take a double top, your entry, your stop loss, that's your target. So that's your stop loss, that's your target, that's your entry. Set and forget basically means you place a trade, you don't care about the trade anymore, right? You don't care about the trade, whether if it hits your target or if it hits your stop loss, it's fine. I don't care about the position. That's what we call set and forget. And yes, I agree that set and forget approach ultimately will make you more money. But the main thing is, do you have the discipline after you experience a huge drawdown and still remain disciplined, and still remain sharp, clear on the position you want to take, and remain crystal clear, having that kind of clarity to find to hunt the setups that you really want. Most traders, when they experience a numbers of drawdown, they tend to throw their trading plan out of the window. Trust me, most traders does that. Even if you try to lie yourself, you can't lie to equity curve. Equity curve is the best reflection of your performance, of your discipline. If you have an equity curve that swings like this is not what I call you are sticking to your plan. Don't try to comfort yourself and say that I'm sticking to my plan, it's fine. This kind of huge swing on your equity curve basically concludes one thing: you are taking trades you are not supposed to take, and you are being disciplined. How can I say? And your discipline is affected by your mood. If you're having good mood, you stick to your discipline. When you're having bad mood, you don't care about your discipline. That's why you have this kind of swing on your equity curve. Do you realize that when you do your back testing, I hope that most of you do your back testing, because a lot of people I've spoken with, they don't back test anything. Whatever strategy that I teach you here in this community, you have to back test them. You have to verify them. What works for me doesn't really mean it works for you, right? So in this case, whenever you're doing your back testing, you always realize that your P&L is a lot better, your performance is a lot better on your back testing. But when it comes to live trading, everything just sort of messed up a little bit. Why? It's because of emotions. It's because when you're trading live, you have a skin in the game. Every single trade is related to monetary, is related to money. Whatever relates to money will affect your emotion, and emotion is what affecting your discipline. They're all a cycle, chain reaction. Right. So second method is what I call skill out method, or what we call trail stops, trade management, whatever. It's basically the same thing. And this technique helps again. In the long term, it does have a little bit lower performance as compared to set and forget approach, but it stables down your equity curve. So assuming now you have a double top, you take your entry here, you have your stop loss, you have your, maybe your TP is here. I don't care where's your TP, but if let's say your TP is beyond your nearest structure, which is in this case, where's our nearest support here? When you're taking a double top pattern, any support near you are a threat to your position. Am I correct? It might come down to your TP towards that previous structure, go back a little bit lower, then reverse back up. I believe all of you have encountered this situation. So what I want you to do is every time when price goes to the nearest structure, do not just hold the position without doing anything, because you got to pay yourself first. You need to learn how to pay yourself first and not just put all the risk on the table. What if it goes down to, maybe your target is 4R? Would you like to see a position go into 3.8R then reverse into your stops? That doesn't feel good, right? I bet that doesn't feel good. So all of you, every time when price goes to the nearest structure, take off partial, or what we call skill out of the trade. You can take off 30%, you can take off 50%. What I suggest is don't take out anything beyond 30%. All right. So that only works in situation where your target is far. If let's say your target is here, you don't need to skill out, just take off your complete position. But if assuming your target is beyond the nearest structure, you need to learn how to take partial. And every time when I take partial, I will start asking myself, should I move my stops to break even, or should I remain my stop loss here? So that is a very tricky question, because if you move your stop loss to break even, right now your stop loss is at an unreasonable placement area. Alright, the reason why you have your stop loss there in the first place is because you believe that if price spikes to your stop loss level, things are not going into your favor, right? But if let's say price comes down but then goes back up, reverse back down again, at least you are still in the game. So this one, I want all of you to do some homework to back test it, see whether should you break even or should you relieve your stop loss there. Because most likely whenever price goes to the nearest structure and you take off 30%, you are almost already break even. Even if price goes to your stop, you are still break even or trade, or maybe small losses. So I want all of you to have this habit. It sounds a little bit too technical, but trust me, in the long term, it really stables down your equity curve. It really stables them down. Because when you take off 30%, let's say price reverse up and you close for break even, you still have that 30%. Even if price all of a sudden hit that previous structure and then reverse all the way into your stops, you still break even, or maybe you are out for a small loss, maybe 0.1% loss. That doesn't really affect you. But if let's say price comes here for 2R or 3R, reverse all the way into your stops, that will be really detrimental to your emotion in the long term. Trust me, if you see that happening for, let's say, 5 times in a row, how are you going to deal with it? Yeah, that's why I say set and forget approach are more for people who are really emotionless, which I think there's no one like this in the market, unless you have 20 years of experience in the market. I personally suggest you to just learn how to take off partial. Take off partial also means you pay yourself first, because you're saying that I don't care what's happening after this, I want to pay myself first. You put a bit of money in your pocket, then you let the remaining position run. Right? If it continues to drop down, of course, yes, your potential profit has dropped a little bit, has dropped for 30% size, but it's fine. We are not in the market to aim for that money. We are here to aim for discipline, to aim for a system. So this sums up today's workshop. So just a quick summary, 3 techniques. The first one is actually having a max daily, weekly or monthly drawdown to make sure you always keep your risk at your top priority. I don't care about if you are a good technical trader, if you are good on reversal, if you are good at certain thing, you need to be a good risk manager first. If you can't control your risk, you can't make money in the long term. So second point is basically managing your risk per trade, which is maybe after 5 winners, you start dropping down risk because you are acknowledging the fact that there are probabilities in the market and you might eventually go through a losing streak. There are cycles. The market has cycles. The same goes to your equity. The same goes to your trading account. So the third point is basically scaling in or scaling out. So what I'm teaching here is scaling out. For scaling in, I'll be specifically doing a workshop on that, and for maybe next week or whatever. Right, so that's it for the workshop. I hope all of you learned something as well. If you can't understand them, watch it a few times and make sure you test them out, back test them. So trade safe, take care. I'll see you on the group.